We've often heard the expression, there are two certainties in life, death and taxes. We're not going to cover the death part of this presentation today, but with respect to taxes, there is a bright side. Unlike death, sometimes taxes can be avoided if done correctly, and minimized or deferred, or at least managed. All businesses, small or large, national or international, need a successful business strategy, which in turn requires careful tax planning. Conducting business internationally, there's special considerations that apply with respect to tax planning. I plan to touch upon a few today. The first thing I want to cover is tax treaties. What is a tax treaty? A tax treaty is like any other treaty. It's an agreement between two governments. And a tax treaty is a specific agreement between two countries as to how they'll deal with taxes. There's three essential ingredients to every tax treaty. One, they're designed to avoid double taxation. Two, they're designed to avoid tax evasion. And three, which is the ultimate purpose of a tax treaty, is to promote commerce and to have an economically stable and certain environment between the two countries so that they know what to expect when they conduct cross-border business. Canada in particular has a particular strong interest in creating a stable and certain international business environment. Canada currently has active treaties with 87 different countries. Most of the folks at this presentation, the countries that they're representing do have tax treaties. In fact, it may be all of the countries represented in this room have a tax treaty with Canada. While there are some differences between the tax treaties, all have the same goals. All are designed to avoid double taxation, avoid tax evasion, and to promote stability and certainty between the countries. So to give an idea of the notion of how a tax treaty is designed to avoid double taxation, for instance, tax on a business profits in most treaties, irrespective of what country it's with, the tax on the business is taxable in the country in which the business is conducted. So, for instance, if business is conducted in Canada, it's taxed in Canada. And if it's let's say, a company from India, the Canada-India Treaty dictates that tax in Canada is going to be deducted from the tax of that company in India, and vice versa. So you're not paying tax for the same business. You're not paying the same tax in two countries. You're paying in one, and you're given credit in another. Another common feature of tax treaties is to have a limit on withholding taxes. Generally speaking, when things like dividends, etc., leave one country to another country, the taxes are withheld at the source. The taxes are withheld at the source country. So, for instance, a dividend from a company with a subsidiary or a shareholder in, let's say, China, if that company transfers or issues a dividend to somebody in another country, normally under the Income Tax Act, the dividend rate is 25%. But if you're a treaty country, often the withholding tax will be limited from 25 to 15%. That's another similar type of added benefit of having a tax treaty where both countries know exactly what's going on in terms of sharing information. The countries are comfortable enough to withhold, to reduce the withholding as part of an overall agreement. The next topic I want to talk about is transfer pricing. Transfer pricing is a hot topic internationally right now. It's often discussed at cross-border business forums. Most recently, there was a case by the name of GlaxoSmithKline versus Her Majesty the Queen, and that case was probably one of the largest transfer pricing cases ever to go to court. It involved in the order of billions of dollars in taxes. And that case essentially was a transfer pricing issue dealing with the cost inputs of drugs. What is transfer pricing? Well, at its most basic level, transfer pricing is managing the cost or revenue in one country when goods are sold to subsidiaries or affiliated corporations in another country. So, for instance, if country A has a high tax rate and country B has a lower tax rate, the affiliated or subsidiary companies, related companies, what have you, when they want to sell products to themselves, essentially, or to those that they're related to in the higher tax jurisdiction, products or inputs, it's in the two parties' interest to charge a higher amount in the lower tax jurisdiction. So, for instance, if they're selling a product in Canada to another country with a lower tax jurisdiction, they'll want to have a higher price for the input in Canada, and which essentially shifts the revenue, the bottom line, onto the lower tax jurisdiction, and it can apply to, and it goes both ways. So essentially, how that's mitigated, what the taxman does is it looks to whether the inputs or the goods sold between the two entities are at a fair market value. And at the end of the day, the determination of transfer pricing all comes down to whether the goods or inputs are sold at fair market value. If they're not, then you have a transfer pricing concern, and the tax jurisdiction can deem certain prices based on what they consider the fair market value. The next topic I want to discuss is permanent establishment. Permanent establishment is essentially the locale of where the business is. It's covered in virtually all tax treaties, if not all tax treaties. And I touched on it earlier, but it's essentially the notion of where the business takes place is where the taxation of those profits, the situs of the profits, where they're taxed. So, for instance, if a company has a factory, for instance, that would be considered a permanent establishment in that country. The question then becomes, what level of activity constitutes conducting business? What level of activity constitutes permanent establishment? Well, generally speaking, a permanent establishment is active business operations, but it may be, based on certain treaties, the act of a single employee representing a company in another country could be considered a permanent establishment, such that that country is considered to be to have a place of business. So generally, you don't want to be you want to be careful not to be considered to have a business in a high tax jurisdiction, or in a situation where you didn't intend to actually have a place of business. So you have to be careful when you're doing cross-border business. The degree to which you're increasing your level of activity is the degree to which you may be found to actually be conducting business. Obviously, straight sales, places of holding inventory, that's not considered a business. Usually there are specific exemptions under various acts. But the greater business involvement and length of time you have in a particular country increases your chance of being considered having a place of business in that country. Just briefly, I would like to talk about the optimal tax structure. Let's assume an Indian company has been selling to Canada, and they have a fantastic sales, and they want to establish, and they intentionally want to have a permanent establishment. They want to set up a business in Canada. How you structure your business will affect the nature and timing of the taxation. The basic forms of business structure are proprietorship, partnership, which includes a limited partnership and a corporation. The most basic form of business structure designed to defer taxes is the corporation. The corporation is a separate entity from the shareholders, and while the income within the corporation stays in the corporation, it's not taxed in the hands of the shareholders. Yes, corporations will pay a corporate tax, but one of the basic features of a corporation is to defer tax from the shareholders in the hands of the shareholders to a later date, to when dividends or payments equivalent to dividends are made. Obviously, those are very basic tax structures. I alluded to avoidance of tax at the beginning of this presentation. In fact, there's a number of complex tax structures that, if properly done, can significantly reduce your taxes. And in fact, there are some tax structures found by the tax court to be permissive in completely eliminating the funds that come out of a corporation. They're very complex. It would be too detailed to discuss them today, but suffice it to say, there are certainly complex tax structures which provide for a significant lawful avoidance of taxation. Very briefly, on the final point, employment issues, employees, you must keep in mind if you have an employee in a particular country, there are certain deductions, source deductions that have to be withheld and remitted to Her Majesty the Queen. And as I alluded to earlier with respect to the issue of permanent establishment, if an employee is found to be acting as an agent on behalf of the company, doing business for a company, one must be careful that that employee doesn't actually convert himself into a place of business so as to attract greater taxation. That's essentially the high points of the presentation. I've touched on a few. If you have any questions for myself or any of my colleagues, we'd certainly be willing to respond to any queries that you may have. Thank you.